everybody, welcome to our insurance review series. I have been getting a lot of queries on Jeevan Shanti, and why not? A lot of investors are looking at fixed return investments given the current pandemic, the volatility that they see. Gold has reached its peak, markets have reached its peak, and people are really tired of the volatility being there for so long, and hence I find a lot of people considering Jeevan Shanti, which is an annuity scheme or a pension scheme. So let us see, how does Jeevan Shanti work? Well, firstly, it's an annuity or a pension scheme, which means at some point it's going to give you a regular pension. You can decide if you want the immediate pension or the deferred annuity scheme. For this video, we are going to be reviewing the deferred annuity scheme for single life, which is going to give you the annuity after 20 years. Now, the way any pension plan works is that you invest lump sum right now. The money remains invested with the insurance company, and then they start giving you regular payouts over a period of time. On the death of the individual, in case of Jeevan Shanti, the family is going to get 1.1 times the amount that has been invested. So let us assume that a person is investing 10 lakh rupees. On this, there is going to be 18% GST. In the deferred annuity scheme, post 20 years, an amount of 1,76,000 rupees is going to be given on a yearly basis as the pension. And on the death of the individual, the family is going to get back rupees 11 lakhs. So let us see how this compares with other investment options that exist. Because whenever you make any investment, it is really to get good returns, right? It's not only to get guaranteed returns, but at the end of the day, you make an investment that's going to give you good returns and at least help you beat inflation. When we considered Jeevan Shanti, we found the XIRR, which is the actual return that the investor makes, works out to 5%. And remember, out of the entire return that's made, there is only that 1 lakh rupees component that's going to be tax-free. The entire pension that has been paid over the 20-year period is going to be fully taxable at the tax slab of the individual. So if a person is making 5% pre-tax, this is actually going to work out to 3.5% post-tax. I don't think any of us want to invest into something that's even not beating inflation. So let us look at the other options that exist. Well, firstly, you have plain and simple fixed deposits available. Now, what happens in a fixed deposit? Let's say you book a 5-year fixed deposit at the rate of 6%, and then you keep renewing it for another 5 years and do this for a period of 20 years. Now, let us assume that from the 20th year onwards, you start withdrawing at a rate of 6% from the deposit. What we wanted to do was that we wanted to keep the amount of withdrawal similar to what you would get in the pension. So we have assumed a 2 lakh rupees withdrawal every year from the fixed deposit towards your monthly requirement. As you can see from the calculation, that for the same period of time, which is that at the age of 86, the individual will still have 28 lakh rupees left in the fixed deposit compared to 11 lakhs that the family is going to get on the death of the individual. So with the fixed deposit, number one, you have more liquidity, you're still able to get that monthly income, and you have a higher amount left at the end of the entire period. Certainly a better investment. From a taxation perspective, of course, the taxation is going to be similar in both the cases. A third option that you have available is to invest into balanced advantage funds. These are also known as hybrid equity funds, which give you a combination of debt and equity. Now remember, LIC themselves invests into debt and equity and gives you returns from both markets. So the only difference is that the return that you're getting from LIC is a fixed return, whereas what you get in a equity or a balance fund is not going to be a fixed return. But let's see how it stacks up in case of the returns. Let us assume that you invest 10 lakh rupees into a balanced advantage fund for the next 20 years, and we're assuming a very conservative return of 10% per annum, which I think is highly achievable. So we break this into two parts. We invest 10 lakhs for 17 years, and then at the end of 17 years, we move that corpus into a debt fund for the next 3 years. This is done so that when the individual actually reaches retirement, then the individual can actually set up a systematic withdrawal plan where they can withdraw a fixed amount every year. In this case, we have assumed a 2 lakh rupees withdrawal that the individual makes every year, keeping in mind similar pension that LIC provides in Jeevan Shanti. Now, as you can see, again, over here at the age of 86, the individual, despite taking the 2 lakh rupees withdrawal every year, is still going to be left with roughly 1 crore 21 lakhs. Yes, the individual is going to be left with 1 crore 21 lakhs. This is simply because the corpus is just growing at a higher rate and is having a longer period to compound. So the corpus is growing here at 10% versus 5% what Jeevan Shanti provides you. And it's compounding over that long 40-year period. And that, my friends, is the reason why the balanced advantage fund is able to give you an overall much better return than what you can get in Jeevan Shanti. So my take, I would not recommend Jeevan Shanti. If you do want to set up a regular income for yourself post-retirement, do consider the balanced advantage fund. Yes, it's slightly more risky, but at the end of the day, you have a chance to build up much more wealth. Don't forget, the returns are much more tax efficient. They're not taxed as per your tax slab. And more importantly, your money is entirely liquid, which means that your money is not stuck somewhere and you can't remove the money. You can easily access your money at any point in time in this scheme. Remember, you pay a very stiff price for fixed returns, and that is really giving up your returns. Think about it, getting 11 lakhs at the age of 86 versus getting 1 crore at the age of 86. There is a huge difference, and that's the price that you're paying for the fixed returns that the pension scheme provides you. Make sure you click on the bell icon to subscribe. We look forward to your feedback. Till then, bye-bye.